How would you sum up 2014 for Royce and Associates?
Almost nothing met our expectations. We had a very disappointing year in the way we would be conventionally measured on absolute and relative returns. We would expect in the long term to do better on both regards.
So as an active manager, what is an acceptable period of underperformance?
Historically, I would have said the most important thing is to measure the results over a given market cycle. Market cycles could be from a couple years to 7 years or so. The question is, how should the average investor look at things? This particular period has been very rough in the last 4 years, which has distorted both the 3-year, 5-year, 10-year performance. So I think you have to look at it actually as a series of rolling returns. In other words, not be so distracted by the current conditions, current underperformance, which have been dramatic, but look at the historic types of returns that this kind of orientation should deliver.
Do you think the investors' focus on tracking error of late is going to have unintended consequences from a market perspective?
The only way you're going to beat the index is not to be like the index. So in the long run, we're always looking for opportunities that are not part of the index, and that should have a payoff. It has not in the last 4 years.
But we've also faced some structural headwinds that as a firm we've never really experienced before with quantitative easing, et cetera, correct?
We've had a dramatic shift in the way the government has interacted with the economy. We have put into place something that actually has never been done before. It was successful in that it has generated certainly asset growth and modest economic growth. It has distorted the way people price assets, and that distortion hasn't been good for our kind of investing.